Good afternoon, everyone, and a warm welcome to this interesting webinar on big opportunity which we see in fixed income investing, especially in corporate bonds. Over the course of next 30 minutes, we'll try and cover 3 points. First, what exactly is the opportunity? What are the reasons for which this opportunity may not last for too long? And third, how should investors capitalize on this opportunity? Joining me for this conversation is Shobhit Mehrotra. Shobhit is head of fixed income at HDFC AMC and possibly manages some of the largest clients' money in the country. Good afternoon, Shobhit, and thanks for joining us this Saturday afternoon. I know post-lunch sessions can be really difficult, but thanks for doing it for us.
Thank you, Vaibhav. Thank you, everyone, for coming in and listening to our views on the Saturday afternoon, and we'll try and make it interesting and useful for everyone to spend this time to understand the dynamics of the bond market.
Absolutely. Really excited and looking forward to this discussion, Shobhit. I'll start with asking a very simple question. What exactly is the opportunity? I heard Howard Marks talking about this great opportunity in US credit instruments. He believes that returns that investors can generate by investing in those will potentially be higher compared to investing in equity. Even in India, we've seen that traditionally, if we invested in fixed deposits, we have not been able to beat inflation. Whereas in corporate bonds, there is a big opportunity to generate real returns, which are over and above inflation. What is your take on that?
Yeah, so see, why are we looking at this as a great opportunity is because of unprecedented rate hikes which have happened since early 22. In the last 4 decades, we haven't seen this kind of rate hikes being done by US Fed since 80s. After 1980s, this is the longest campaign which the Fed has undertaken to hike rates from almost zero bound to 5/4, 5/2 today. 500 basis points of rate hikes in a very short span of time after 4 decades is bringing up a great opportunity, because now we are at the fag end of the rate hiking cycle. If you look at the entire reason why such rate hikes were needed, if you look at how much has already been done, and then look at the scenario where we are today, you would probably tend to agree that perhaps we are at the very last stage of the rate hiking cycle, and typically from here, maybe within 6 to 9 months, or at best 12 months, the cycle completely turns, and the Fed would perhaps start cutting interest rates. So this is a great period of the next 6 to 12-month period when rates are at their peak, yields are at their peak, and Fed maybe within 12 months or so would be turning the rate hiking cycle, and therefore bond portfolios, bond investments start seeing capital gains. And this is where the total return which investor earns on the bond portfolio or investment significantly goes up. So you are entering at a high yield, and within 6-12 months, if the rate cycle turns, rate cuts start, that is the stage when capital gains start building in, and that takes the total return on bond portfolios pretty attractive. And that is why we feel it's a great opportunity. Why did the Fed raise rates so much? We all know what happened during COVID. A huge amount of fiscal stimulus was provided in the US. US fiscal deficit went as high as 12%. Huge amount of fiscal stimulus combined with huge amount of supply disruption. So supply was not there, demand was very strong, and obviously inflation went over the roof. and inflation closer to 9% in the US, perhaps not seen, in a long time. Therefore, Fed had to act so aggressively. They did all these rate hikes beginning in 22. Most people now expect Fed to stay put. There is this very small probability that perhaps Fed may do one more hike. But large chunk of the market believes that the rate hiking cycle is getting over. We are getting to the last stage where now things should stay at these high levels for some longer period, but thereafter, we are looking at a scenario where the rate cycle will turn and we will start seeing rates easing or rates being cut, which will be hugely profitable for bond investing. And that is why the opportunity is there from now till next 12 months or so.
Absolutely, Shobhit, you've been managing fixed income money for a long period of time. There are rare occasions where you get very high accrual with high potential capital gain in fixed income investing. So we are also looking at the data, and the data is suggestive of the fact that we are pretty much at the fag end of this interest rate cycle. If we look at the previous cycles, the average interest rate cycle has lasted between 15 to 18 months. And obviously, there are other data points which are supportive of low interest rates, especially in Indian markets. We recently seen announcement by JP Morgan that they will be infusing significant part of their corpus, fixed income corpus, in Indian fixed income securities. Along with that, especially in India, we're seeing that core inflation has trended downwards. And impact of high interest rate on GDP growth number is also starting to show up. You mentioned about this, that this may not last for more than 6 to 9 months. How should investors play this? And what are the disadvantages of not capturing this interest rate opportunity in the current market environment? I also have an additional question which pertains to whether investors should look at corporate bonds. Traditionally, you've seen that fixed income investing for us meant investing in fixed deposits. But unfortunately, fixed deposits have never been able to generate any real returns. So how should investors look at this opportunity differently? And which are the ways in which they can benefit from investing in these bonds?
Yeah. So I think for investors, clearly the phase from now till the rate easing cycle begins offers a period when, ideally speaking, investors should be adding duration on their portfolio. There are various ways of adding duration. Typically what we have seen in India, even if investors are exposed to mutual funds, they would be overweight on liquid or extreme short end. So liquid funds typically have only 3-month kind of average investment period or maturity profile. So overwhelming majority of investors, especially retail, HNIs, etc., have been in the up to 1 year category, which is liquid, ultra short, floating rate, or money market. Now, ideally speaking, in a scenario when the view is about to change and when the rate easing is around the corner, that is the phase when overall portfolio duration of the investor needs to be higher. Now, there are various ways to play this. There are several categories of fund which are looking quite interesting, whether it is a short-term category, short-term bond, corporate bond, medium term, credit risk. So all these are approximately to 3 to 5 year average maturity portfolios. Very good on overall credit quality. The duration also is not significantly high. It's just around 3 to 4 years of modified duration. and give you a fairly high portfolio yield. Overall portfolio yield is pretty high, and the return which people would expect would be again linked to market rates, the movement of market yields, and the idea would be to go and increase overall duration from shifting money from, say, liquid, ultra short, and up to 1 year category into the next big category of 3 to 5 year segment, and increase your overall portfolio duration. The other way to take advantage is to directly invest good quality corporate bonds, whether they are of NBFCs or whether they are of other manufacturing companies. But there are now fairly good number of corporates or finance companies, non-banking finance companies, which are offer very good quality and are offering a decent bond spread over, say, a comparable maturity GSEC. So corporate bond spread is attractive. Overall yield is attractive, in some cases going as high as double digit. So that is a great option which investors can look at.
No, absolutely. And that's where our view is also. We are expecting a reasonable amount of downtick in the interest rates, and especially in the Indian context, where not just interest rates, but other factors are also extremely positive. The balance sheets are not very leveraged. So debt liability of private corporates is not very high. So all these factors are extremely positive. Combining these with the other macro factors, we believe that over next 3 to 6 months time, interest rates in India will come down meaningfully. Moving on, the next question that I had, Shobhit, for you was, and we have put together this interesting decision tree. What are the options that investors have today? Either they can invest in this high interest opportunity which is there in front of us, or they can wait it out. There are a couple of views in the market where people have said that maybe it's 3 to 6 months time further you should wait. And we have kind of created this decision tree, and which in our view encapsulates our view. Any thoughts on this?
So I think, see, my two bits on how to go about is it's very difficult to do perfect timing of the market, and nobody knows the perfectly when the market will bottom out or when the market will peak out. So catching peaks and bottoms is very, very difficult. For even professionals it is very difficult. So for other investors also it is equally difficult, and it's not possible. So the best thing is to stagger your investments over a period of time, and invest on a regular basis. So if today, if most people expect that next 6-12 months is a great opportunity, I would say no point in waiting for the 6-12 month period to end, because nobody knows when the things will change, and they can change in a very quick and sharp manner. Suddenly overnight something happens globally, and situation can change. So it is best to keep investing regularly, not wait to time the market, go about it in a very disciplined and consistent manner, and just take a overall asset allocation needs to be done, and overall portfolio duration decision on that needs to be taken. So if somebody is probably running a portfolio of, say, 6 months, 12 or to 12 months, then the idea is to shift it to at least towards 2 years or 3 years. Then it needs to be done as early as possible, and do it over maybe in the next 3 months, 6 months at best. So regularly doing it, not trying to time it to perfection, and just taking a overall asset allocation decision, and then shifting it out quick in a staggered manner. I think that would be the best way to go about it.
Absolutely, Shobhit, and our view is also similar. We believe that interest rates are high, therefore you can capture very high accrual. even if rates, and I'll spend a minute on this chart so that we can explain it in greater details. So our view is that if interest rates don't go down, even then you are generating much higher accrual in this category of corporate bonds. You can generate 200 to 300 basis higher than what you would generate otherwise. And combine that with a scenario where interest rates go down, you can generate a capital gain of 2 to 3%. So at an aggregate level, your returns can be 12-13% in this opportunity for next 15 to 18 months. On the other hand, if you keep your money in FDs and short-term instruments like what Shobhit mentioned, then your portfolio will generate significantly lower returns. In fact, most of the times, the fixed income portfolio generates returns lower than the inflation, which eats into your purchasing power. Your other option is to wait for some more time, but if the rates go down sharply, as Shobhit mentioned, things can move very quickly in this global environment, then you will miss out on this great opportunity. Our view, Shobhit, is that someone who is trying to balance between high accrual and uh, low risk on the duration side, credit risk funds and corporate bond instruments are much better compared to investing in long duration. The reason is there is significant accrual loss, which is there if you invest in long duration bonds or PSU and government securities. What is your take on that? Uh, if we look at the comparison, the returns in those categories are 7.5%, where in this category it can go beyond 10%. So would love to understand your views on that. And before Shobhit responds to that, I'll remind all the participants to keep asking questions, and we'll take it up during the webinar or at the end of the webinar.
Yeah, so I think credit products, have had a history where, there was a rough patch or rough phase. We've all come out of it, and thankfully now the category as such looks interesting because several changes have happened since COVID 2020. Everybody remembers what happened with the large fund house winding up 6 schemes and all that. So all that is history. There have been a lot of learnings from that whole, experience which we got. And today the portfolios are quite solid. The opportunity is good because 8.5 or closer to 8.5 on the portfolio yield, with the potential to capture some compression of spread and the move on the rate cycle. If interest rate cycle completely turns in over the course of next 1 year plus, then you capture not only that move, you all will also capture some bit of compression of spread, and any rating upgrade or rating transitions which happen typically during over the course of the corporate cycle or capex cycle. As it improves, you find a lot of companies going from single A to A plus and A plus to AA minus, and they move up the rating curve. And this also brings in an element of potential gain because the spread benefits from the upward movement on the rating trajectory. As the rating improves, there is the compression of spread, which also adds to the overall capital gain and overall return for the investor. So that is definitely a great option to look at. Credit risk category, predominantly now there are two large players in this space, and therefore not a category which has seen massive amount of inflows, and opportunities are not present, and people are struggling to find good assets. So all that is not the case, thankfully, which was earlier. We've seen in previous cycles there have been opportunity, too much money flowing into this category, and reducing the opportunities for everyone. So that is today is a much better environment to get into credit risk space. Other than that, yes, selectively investing directly in corporate bonds. Now, the key here is to pick and choose the right credit. The credit selection, due diligence on the credit, of what you are investing, which companies' bonds are we investing in. I think that would hold the key. If the due diligence and homework has been done well, obviously the company's bond can be invested in, and you will make a very good return, if held till maturity, or even if you trade it out. But the key here is to select the right credit. A number of people we've seen in the past have been influenced at times by the rating, or at times by something else, which has led to them not realizing the potential which this opportunity has presented itself. But the key is to identify good quality companies, and I am sure you, as a being in this industry for a long time, the names which you recommend to your investors, the groundwork has already been done, and therefore the due diligence part is taken care of. And if investors go with those kind of names, I'm sure the experience would be fairly good.
No, absolutely. The way we approach it is look at the basket of bonds and do deep diligence on them. And one interesting point that you made around ratings, that ratings can create this false illusion of safety. And as all of us are aware that over the last 3-4 years, all the large defaults have happened in highly rated instruments. So we strongly believe that we have to look at the parameters which are beyond rating and do a deep dive. And honestly, a deep expertise is needed to do this. As an individual investor, it's very difficult to run this kind of a process. So our strong belief is that for investors looking to invest in this space, should either look at professional fund management or not do it, because doing it without that proper guidance and diligence will be extremely risky. We run a thorough diligence process and are able to generate significantly higher amount of returns without any significant risk addition. So that's what we do. I had a follow-up question to that. There are a lot of questions around what will happen if this Israel and Hamas war were to escalate, and what kind of risk we see emerging for fixed income investors in this environment.
Yeah, so I think the geopolitical risk of this conflict it's actually been going on now from 6th October. It's been almost 2-3 weeks and above. So till now, the situation is not spread from Israel outwards. The big worry is, in case this warlike situation were to spread out, i.e., other countries like Iran or Palestine or something, it spreads out of that conflict between Israel and Hamas into something bigger. Then I think the market would see, I think, the first impact on the crude oil prices. Crude oil prices would rise. So, already we are closer to 90-95. It could perhaps go over $100 per barrel. So crude will have an impact. The other major impact would be on currencies. For across the board, dollar would become stronger because of rush to safe haven, which the status of dollar is. The flows which one were expecting to come into emerging market countries would get impacted. So our currency could come under pressure. So growth will suffer. You can have a scenario where the Fed, even if it was thinking of perhaps one more last hike, would drop that, and perhaps rates would start easing far sooner than if the conflict were not to spread. So the worst case scenario is if this were to spread out and involve more countries, then I think the impact on commodities, crude, currencies is going to be significant. In fact, it will have impact even on the other asset markets like equities and across the board, and which could bring in a scenario where the Fed would have to start easing rates far sooner than otherwise they would have.
No, absolutely. And a lot of interesting insights on that. to summarize what we discussed so far is look at this opportunity with a high priority. There's a great opportunity in front of us where we can generate significantly higher returns by investing in fixed income. Be mindful of the process that you're following to invest in these securities, and don't delay your decision. So these are some of the takeaways for me from this discussion. War will keep happening, and I think if Mossad could not predict that Hamas would attack on them, we can't predict when will Israel stop that war. So it's a futile exercise, and we should not spend our energy on that. We have a lot of questions which have come our way. I'll start picking a few of them. Uh, Manu is asking, I'm an investor in debt strategy. One of the parameters to compare is also volatility NAV. So apart from moderate liquidity, low diversification, we should also be aware of volatility. Absolutely, Manu, and that's why both Shobhit and I have recommended that you invest in bonds with 3 to 4 years maturity, where you generate much higher accrual and don't see too much volatility in the NAV movement. One interesting question is, what are the best strategies for investing in bonds through PMSs? We run this PMS where we run deep diligence on certain corporate bonds and create a basket of 6, 7 bonds in that PMS with active oversight on the portfolio. And that allows us to monitor if any kind of action needs to be taken in the portfolio, and are able to generate significantly higher returns. Avinash has a question. If return expected from bonds is in the range of 8.5%, and return from liquid funds is 7.25%. If I'm understanding the question correctly, the question is, why should we invest in bonds instead of liquid funds? Shobhit covered it. There's a concept called reinvestment risk. Liquid funds have very short maturity, and bonds have much longer maturity. Shobhit, you want to add anything there?
Yeah, I think this fact or this thing is not well appreciated by most people about reinvestment. So typically, I think liquid fund is a 3 month kind of maturity portfolio. Look at a scenario. I'm just maybe to make the point clearer to everyone. I think most people, when they look at these portfolios, they tend to assume that this kind of a 7 quarter return will continue for next 1 year, 2 year, 3 year. But as we said, 90-day portfolio. After 90 days, just for a moment, consider that what if interest rates go down by 100 basis points. This liquid fund return, therefore, will go from 7 quarter to 6 quarter or even lower. So while a short-term bond fund will give you capital gains, so that is where the difference lies. That the bond prices will go up significantly for 1, 2 year, 3 year bonds which are there in the portfolio of other funds, and therefore the capital gain will be beneficial for the overall return of the investor. While in the liquid, because now we will be investing at 100 basis points lower, the portfolio yield will drop to 6 quarter, and therefore the returns will go down. So that is where the big delta or the difference in return can come. That on one fund you will see massive decline in return, on the other you can see a gain.
Yeah. No, this is quite useful. Another question which has come, and I'll take that up. The question is, I've seen direct bonds on Wind. How's Dezerv different? See, there are many platforms on which individual bond offerings are there. But as Shobhit explained to us, doing a deep diligence on underlying companies is an important part of building a portfolio. If these platforms are doing that, then obviously you can go ahead and invest. At Dezerv, we run a very tight process. Do a deep diligence. The entire process is divided across multiple parameters, and which allows us to keep your money safe and yet generate high returns. So I'll urge you to look at the process that is followed by other platforms to understand how they are able to safeguard your money. So the question is there from Varun, what is the percentage increase in risk in corporate bonds versus GSEC versus gold bonds? So Shobhit, any thoughts there? My initial reading is that it's misunderstood. There is a little bit of misunderstanding there of risk.
Yeah, so I see basically the spread differential is for the risk-free status of the sovereign is the government bond yield, right? And all the extra yield pickup which we are getting, whether it is a AAA bond or double A or single A or anything else, is basically capturing in all the risks which are there, of investing into anything else apart from the sovereign risk-free asset. So that is where the risk-reward compensation is there. If you invest in a corporate paper, you get compensated by earning that extra spread, which is capturing that additional risk which we are taking of investing in a particular company, and therefore, that's how one has to look at it. But the key here would be that you pick and select AAA name or double A names or corporates wherein the risk reward trade off is in your favor. That you know that this is a solid AAA name and a genuine AAA. And therefore, if I'm getting, say, 40, 50, 60 basis points extra, then why leave it? And might as well capture it. And therefore, and keep doing that over and over for a double A category or even a single A company. And there are very good quality single A credits also available, and which will offer you significantly higher yield. But again, the key is to make that right selection. And if you have done that right selection, then that extra yield pickup will add to your total return.
No, perfect. That's absolutely perfect, Shobhit. Another question which is there from Jekin is, should one look at investing into credit papers which are rated only by CRISIL? I have shared my views that we don't look at only credit ratings. We look at parameters beyond that. But Shobhit, any incremental thoughts there?
Yes, I think that is same thing, same philosophy which we follow at HDFC. We go far beyond the ratings. Rating is just one of the input. Rating is a subjective issue. It's an opinion by a rating agency on the company's credit quality, and we do our own research. You just like you do your own process and research. We also have a elaborate setup and the entire process which we follow, and that is why we have not taken exposure in several of the AAA names which the entire mutual fund industry was exposed to and had taken. But thankfully, we, at least at HDFC, we were not involved in a lot of those accidents which happened in the industry on good quality credits. So we were able to escape because of our this own process where we were going far beyond the rating. So that is very critical, that you need to go beyond the rating, and that is where all the experience and everything comes into play of being in these markets for a very long period of time, and figuring out who to trust with your money. That is the key, especially in India.
True, absolutely agreed. Another question is around new age debt products like invoice discounting and P2P. Karthik, we have always stayed away from products which are not tightly regulated. There is always a risk where investors' interest can get compromised. Shobhit, have you seen these products and any thoughts on that?
No, actually, I would not be the right person to comment on it. But yes, I would also tend to look at it with a lot of, skepticism. At least needs to be, you need to spend a lot of time first figuring out whether the whole process there is working in a, in a very structured manner. So if the whole identification of, counterparties or the due diligence process, the entire thing is being done in a very professional manner, only then I would want to get into all that. But for lack of time or and the kind of effort needed to put in for doing all this is very, very difficult. Therefore, it's better to stay away. But that's my own personal view that it's not very easy to figure out whether the whole thing is being done in a professional manner.
I absolutely agree. And the point that we always think about is regulatory oversight when it comes to these instruments is extremely important.
Right.
The other question, and which is more relevant for Dezerv, Meha has a question on her portfolio Dezerv. She doesn't have any allocation to fixed income. Yeah, Meha, our team will reach out to you to understand your requirement and make the changes in the portfolio accordingly. The other question is around the fee structure that we charge. So obviously, like in all our products, we continue to believe that we should make money only if our clients do. So there is no fixed fee. We charge a percentage of profit to make sure that alignment of interest remains high. So Venkataraman has a question: what are junk bonds and how should we avoid these? So we'll take one more question, and yeah. So this is the last question that I'll take, and rest of the questions our team will respond to. We'll try and respond to all the questions.
So I think junk bonds, by definition, are uh, considered those which are below investment grade rating. So in India, I think, or globally also, triple B minus up to triple B category is considered investment grade, and below investment grade is junk category. So junk is basically distressed kind of companies, which junk bond market in globally in the US is quite big. But in India, we typically treat even companies below A minus as junk, or anything in even in triple B plus or minus doesn't don't trade. Large volumes of trade or actual investment which happens in India is restricted only up to single A category. And that anything below that is kind of considered all junk, but technically it is below investment grade, which is junk, and considered speculative, and up to triple B category is investment grade.
No, this is quite useful. I think there is one last question that I'll take because there's an interesting one. Prabhat is asking, my portfolio is completely equity-based mutual fund. How should I restructure it? Shobhit, any thoughts on asset allocation? I strongly believe that investors should have money across asset classes, and depending on their investment requirements, they can rebalance the portfolio. But Shobhit would love to have your view also on this.
Yeah, I think asset allocation is the key. Typically, diversification across different assets and within that asset class also. So I think that there are few pointers which investors need to keep in mind. And I was reading this interesting book which said that the hardest thing about investing is not intellectual, it is emotional. So a lot of investing people tend to think is all about it's very complex and very intellectual and this and that, but at a very simple level, if you keep it quite simple and understand your own behavior of how to go about looking at your entire investments, then it can be made very simplified. And therefore broad asset level diversification, wherein having exposure to not only equity but other asset classes like fixed income, gold, say commodities or real estate. If you look at everything put together, that's your broadest sense of all assets. Having it diversified and having the right time frame in mind, and not looking at it on a very short term basis. So taking a long term view, 5-10 year view, leaving your assets to or asset allocation in place for that much period, and not frequently getting worked up with the market movements. People tend to get extremely worked up when market is at its bottom or at the top. You've all heard about greed and fear, which come into play. So that all that, I think, keeping your own uh, behavior on or rationality during these periods is very important, and having a very enough long term time horizon in mind, I think that is very important while deciding on how to go about it.
This is quite useful, Shobhit. We have one live question. Avinash had a question, and with this, we'll try and wrap this session. Hi, Avinash.
Hi, Vaibhav. Thank you so much. Thank you so much, Shobhit, for a very informative session. I had a question basically on the bonds and the liquid funds that we have. The
Yeah.
bonds have a maturity, a defined maturity, whereas the liquid funds, although, like for example, the short-term liquid funds, they have a maturity of say 90 days or so, but we can actually stay invested in it. And hence what happens is, and the bonds as well as the liquid funds are subject to the same income tax slabs, whereas in a bond after maturity we necessarily have mandatorily have to actually pay the income tax, whereas in a liquid fund we pay a tax only if we actually redeem.
Absolutely. So
Yeah.
yeah, so basically the deferment of tax is also a big advantage that applies to any mutual fund category, any product, whether it is liquid, short term, any fund. So if you are stay put or stay invested in a debt fund for whatever period, only when you exit the tax incidence comes into play. So if you are in a liquid fund and you stay invested for 5 years, you don't have to pay tax. Basically, once you exit, when you get out of the product, only then whatever taxes have been need to be really computed and then paid out.
Yeah.
So, Avinash, just to add to that, like in the case of mutual funds, like liquid funds, where security maturities, reinvestment of that is handled by the mutual funds. In the case of all the mutual fund schemes and our Dezerv PMS also, we manage the reinvestment of the proceeds. So money never comes back to you. Uh, so obviously you don't have any pressure to reinvest that money. So I hope that answers your question.
Yeah, I mean, honestly speaking, I'm still not a little convinced on this, basically because you see, this is some a chunk of money that you actually park in a liquid fund, which you probably it's there as an emergency. It's basically there for an emergency sake. You withdraw it only if you really need it, and it's available to you within a day. Uh, Whereas
So
the
Avinash,
bonds and
sorry, go ahead, go ahead.
no. So basically, I was just trying to compare, the returns that we get from the liquid funds as well as from the bonds. It's really not very high. The difference is not very high, and the income tax also. I mean, yes, I do agree with you. Only in the case if you redeem completely, yes, then you would be able to compare the liquid funds and the bonds apple to apple. But otherwise, I mean, you just stay invested in there, and your money grows at say about 7 point. Like for example, I have invested in a liquid fund, and I have been invested in it for the last 4 years, and I'm on an average I'm getting a return of about 7.26 to 25% or so. Yeah. So
Yeah.
and
Yeah.
I'm
So
not paying any income tax on it.
yeah. So I'll tell you how it will change. Basically, when you're sitting today and you have to plan for the next 1 to 2 year period. Now, what reinvestment will do to liquid fund returns is what needs to be looked at. Now, this 7.25 which we are earning today, my view is that over the course of next 2 years, the average return on this will go down as interest rate cycle turns and the portfolios get reinvested at lower and lower and lower yields. The portfolio return of liquid will go down, and therefore your return of an investor return will also keep going down because the cycle is turning. And the opposite will happen in the other categories. Short term bond funds will see appreciation because of yields going down, and therefore the difference, when you 2 years from now, when you will look at your average yield which you have earned on liquid, will look very different from what you have earned in the last 2 years, because you have to look at what the next 1 to 2 year view is from now, and that is where the difference lies. And the other categories, it is going to be so the difference today, while maybe it is appearing very less, because bonds are yielding you 8 quarter or whatever, around 8ish. These are around 7 quarters. So why do that? But 1 year from now, a liquid fund return will definitely be significantly lower.
Okay.
Yeah, and additionally, obviously, all the investors would have different buckets. You would not keep all your money in liquid funds, or you would not keep all your money in bonds.
Yeah,
So
of
there
course.
has to be allocation decision. The money that you'll need at short notice without any volatility should be kept in liquid. But money
Yeah.
which is available for 1 to 2 years should definitely move away from liquid funds.
Yeah, of course.
Shobhit, really enjoyed this conversation. Some interesting takeaways for me also, and strong recommendation to all our investors to invest money in fixed income. This kind of opportunity rarely comes. Anyone who wants to understand more about our investing process and deserves investment offerings can reach out to our member partners. Thanks a lot, everyone. Thanks, Shobhit.
Thank you. Thank you,
Thank you.
everyone.
Thank you.